Money. Crazy about my money. Crazy about my money.
Well, it's that time of year again. Scroll through social media for more than a few minutes, and you're sure to see politically charged posts about gas prices, inflation, and interest rates. But does the president really have any control over those issues? Let's examine some myths. Contrary to popular belief, presidents have almost no impact on interest rates other than appointing members to the Federal Reserve. Member terms are staggered in 14-year increments and don't follow political cycles. Appointees also require congressional approval. There are 12 voting members, each of whom have minimal impact on any single decision. There are, in fact, no documented instances in which a Federal Reserve decision was impacted by political prejudice. I suppose an argument could be made that Federal Reserve Chair Arthur Burns made some questionable decisions in the early 1970s that may have been in relationship to his friendship with Richard Nixon. Still, the other voting members for the Federal Reserve who were not politically aligned with Nixon also had to agree to any policy decisions. In other words, Burns didn't act alone. Interest rate changes are implemented by 12 decision makers, but their decisions are driven by conditions in the broad economy. The independence of the Federal Reserve is key to sound economic policy and should remain free from any political influence. That's not to say that interest rates and monetary policy doesn't have an impact on politics. It absolutely does. But historically speaking, there aren't examples in which independent voting members for the Federal Reserve conspired to influence a political outcome one way or the other. Recent interest rate increases, for instance, were done in response to inflationary pressures that stemmed from COVID. The decision to raise rates in 2022 really had nothing to do with a political party in office and everything to do with concerns about inflation. Likewise, when interest rates decline in September or November of this year, it will be driven by economic data rather than political affiliation. For the record, rate cuts have been so telegraphed leading up to this point that it really shouldn't move the needle one way or the other, politically speaking. Regardless of who wins in November, interest rates are heading lower so long as inflation remains subdued. That brings us to our next topic, inflation. Inflation occurs for one of two reasons: the shortage of a resource or the abundance of money. Take the inflation issues of the 1970s. Inflation actually began to rise in 1966 during the Lyndon Johnson administration and continued to rise for the next 3 presidential terms under Nixon, Ford, and Carter. The inflation issue wasn't isolated to a political party. Rather, the money supply in the country grew by 42% in the 1960s and 78% in the 1970s, a dramatic increase compared to the previous decades. The additional money injected into the economy led to the rising prices. In many cases, inflation issues can be traced back to poor monetary policy decisions by the Federal Reserve. Yes, they do make mistakes. And excessive government spending, which really falls more on Congress than the president. The recent inflation we experienced in 2021 and 2022 was directly related to an abundance of economic stimulus coupled with supply chain issues that created a shortage of nearly everything. While President Trump signed the $2.2 trillion CARES Act package in March of 2020, he shouldn't be blamed for the inflation that followed. Nor should President Biden, who signed a $1.9 trillion stimulus package following his election. In both cases, the bills passed through Congress before being signed by the president. The passage of each act had little to do with the political party in office and everything to do with supporting the economy during COVID. Furthermore, some level of stimulus was undoubtedly needed to help the economy avoid a deeper recession. The Russia-Ukraine war further constrained supply chains and created shortages of oil and gas, leading to higher prices at the pump and ultimately higher prices of everyday goods for Americans. This leads to our next topic, gas prices. Oil is a global commodity, produced primarily in foreign countries. The price of oil is driven by usage and demand. Oil prices rise when demand increases and declines during times of global recessions when demand is low. Prices may rise when hurricanes impact supply or when oil-producing countries reduce production. Oil prices are a great example of that classic supply versus demand chart. Nowhere does the president actually factor into oil prices. Under President Obama, for instance, gas prices fell from a high of $3.95 in 2013 to a low of $1.43 in 2016. But they rose again during President Trump's term to $2.87 a gallon in October of 18, and then fell again to $1.40 a gallon during COVID in April of 2020. The fact that gas prices fell during Obama's term and rose during the first 2 years of Trump's term had nothing to do with political policies of either party. When gas prices hit $1.40 a gallon in April of 2020, it was all about the collapsing global demand and not political policies. So if presidents don't impact interest rates, inflation, or oil prices, what impact do presidents have on the U.S. economy? Well, not as much as they get credit for or blame for. Presidents may indirectly set the tone for the economy by voicing pro-business policies or addressing desired policy changes in speeches. The president can also shape the agendas of regulatory agencies such as the Federal Trade Commission. But the president alone can't determine tax policy without the cooperation of Congress. Most of the direct presidential impact on the economy is isolated to global trade with foreign countries. The president can, for instance, negotiate trade deals and impose tariffs up to a certain point without congressional action. When the same political party controls the executive and congressional branches of government, policy is obviously more likely to move in one direction. But presidential influence is really limited beyond that point. The outcome of the presidential election is just one input in a very complex web of free markets, consumer confidence, foreign leaders, geopolitical events, and changing population demographics that all play a role in shaping this nation's economy. Elections do matter. They just aren't as important for the economy as many would have you believe. Regardless of the outcome in November, consumers will continue to shop, travel, and spend. Businesses will continue to advertise and innovate. Both political parties have a history of recessions and economic expansions. Historical stock market returns, believe it or not, are nearly identical under each party. The outcome in November may be exciting or upsetting for many reasons, but please don't let it be a leading factor in your investment decisions. The economy will be fine, or it won't be, but either way, it isn't likely due to the result of who wins in November. There are many feasible scenarios for the path of the economy over the next 4 years. We continue to believe that diversification and risk management are the keys to success. We sincerely appreciate your continued confidence and trust as we help you navigate this changing environment. As always, feel free to reach out if you have any questions or concerns that you'd like us to address. Thanks.
Crazy about my money.